Hello everyone. Welcome to Chapter 13. I'm going to briefly go over the highlights of Chapter 13 in the first video, and then in video 2 and 3 I have examples for you that are going to be just like the lab problems you have in the assignment for Chapter 13, the last two problems. So let's take a few minutes to go over some of the highlights. This chapter and the next chapter really focus on the setup of corporations. Corporations, Smart Touch Learning is instantly, magically going to become a corporation in this chapter. They went from a service business in the beginning to a merchandising business in Chapter 5, and now they're a corporation. Okay, and corporations are a separate legal entity. Aside from their owners, they file their own tax return. I say they like they're a person because they are a separate entity from their owners. The corporations we're going to be studying are corporations that sell their shares of stock on the stock market, on the stock exchange, the New York Stock Exchange, either NASDAQ or the actual, the Dow. That escapes me for a minute. The Dow or the NASDAQ. Those are the two main ones we have. And this chapter focuses on issuing, they call it selling shares of stock. There are many corporations that do not sell shares of stock. They're called privately held. And these that do sell are called publicly traded. So in the first section, pages 688 to 691, it tries to familiarize you with the background of stock, some of the terminology that's used. They show you a picture of a stock certificate on page 689. If you're looking at slides, it's 3.5 to 3.13. Just briefly, I wanted to call your attention to the pie chart on page 690. And I like this pie chart because it's color-coded. I always think that's so useful. It's page 690, exhibit 13-3. You can see, if you're looking, you can see the blue circle. That's how many the SEC is, the Security and Exchange Commission, that regulates all things publicly traded. They're the police of that. They regulate, they come down on you if you're not doing it right. You have to put everything through them. They tell you how many shares you are authorized to issue. That can go up if you have a good reason for doing so. But again, they police everything. They're like the Congress of everything stock. The smaller orange circle, that's what's issued. Issued means sold to the public. And that's that second circle. And then you see there's like a reddish, almost looks orange too, but it's more reddish orange, tangerine if you will. That's called outstanding, and that means number of shares still out there to the public. You might say, why would they be different? Well, they would be different, and the outstanding would be a smaller number if the corporation bought back any. And this is called Treasury Stock. When the corporation buys previously sold shares and brings them back into the corporation, that's called Treasury Stock. And I'll tell you more about that in a couple of minutes. But you always need to know how many shares are outstanding. So if you have issued minus any Treasury stock, say for instance, I wrote myself a little example. If you issued 35,000 shares of stock and you bought back 2,000 shares for Treasury stock, outstanding shares would be 35 minus 2, or 30, I'm not answering yet, or 33,000 shares would be the outstanding. Okay, notice that it's always a smaller number. I wish that lady would shut up. The difference between what's issued minus if the Treasury stock has been, repurchased back, you have to subtract that out to get the number of shares outstanding. It's kind of a big deal because when When you pay, it's okay, went away, thank God. When you pay, that really threw me off, dividends, okay? Or you distribute dividends for stock. There's both cash and stock dividends. Again, more about that coming up. You always need to know the number of shares outstanding, and you don't pay dividends naturally if on shares you've repurchased. So they would only be paid on the number of shares outstanding. Okay? So that's kind of the first section. In the second section, let me see, we have them actually issuing some stock. Again, issued means sold. And companies have common stock. All companies have common stock that sells stock. It's called common stock for a good reason. It's the most common form. And it's a basic ownership. About, I would say 40%-ish of corporations also have what we call preferred stock. It's called preferred for a couple of reasons. It's more expensive than common stock. They get paid first, dividend-wise. And if there's not enough money after they get paid, common stock shareholders don't get anything, unfortunately, because preferred stock is kind of a stated fixed rate. You can either get a percentage of the shares outstanding, or you can get a flat dollar amount. More about that a little bit later. But common stock gets paid after preferred. There's almost always fewer preferred shares that are authorized and issued and outstanding. Also, you don't do treasury stock with preferred shares like you do with common. Whoops. But they probably, as little as 5 years ago, the number was only about 30% of companies that had preferred, but now it's gone up like around 40-ish%. So it's getting more popular. People like it because they know what they're going to get. It's kind of a state, it's almost like this is a contract, this is what you're getting. Okay, sometimes it's called a perpetuity, which means the payments go on forever as long as you own the stock. So, it's a finance word, it's kind of a big word, but anyway, you don't have to know that. So we see in these pages, let me catch up with the slides. I am on 692, slide 13-12, which I'm not keeping up with myself here, which shows you the common and preferred stock that I already talked to you about. The other big term in here that you'll see all the time is par value. Par value is just an arbitrary assigned amount that corporations assign to their shares, and they usually assign them low so they can sell it for more than par and it won't be like undervalued. If companies don't know what to assign, the SEC will suggest a par value for you. Almost all states have it. There's 5 or 6 that don't. If a company does business in a state that doesn't have a rule that you have to have par, you can have what's called stated value, which is treated exactly the same way. Okay? If it's a no par, you don't have any choice but to record it for what you sold it for. In these next few pages, let's see, I know I wrote this down. Okay, 692 to 696. You're going to see examples of selling at par, which is exactly the cost is par, they equal. You're going to see there's selling at a premium, which everybody wants. It's sold above par value. Anything additionally would be called paid in capital in excess of par. Unfortunately, that's a very long name of an account. Paid-in capital in excess of par. There's one for common stock. There's a paid-in capital in excess of par for preferred stock as well. So just watch out for that difference. I'm going to show you an example in a minute. But I just want to go back just for a second on 691 before I flip. I left one thing out. Stockholders equity, we used to call it owner's equity back in 101, the capital account. Now we're going to call that owner's equity stockholders or shareholders equity. It's the same thing, except now it has two components, right? It has retained earnings, which is just like the old capital account. It's the beginning plus the net income. Used to be minus withdrawal. Now we're going to minus dividends, which are withdrawals for many, right? Equals ending, the same statement of owner's equity. It's going to be called the statement of stockholders' equity. Same thing. But we have an additional component we're adding into this stockholders' equity, and it's called paid-in capital. That's all of the money your shareholders give you to buy the stock, both the par and the in excess of par. Everything you collect from your shareholders is paid in capital. It's a component of stockholders' equity, along with retained earnings. Okay? Retained earnings got that name because it's what you don't pay out to your shareholders, what you retain. Okay? So kind of left that out, and I think it's an important thing. So just in the next few pages, it's going to show you examples of issuing stock at par that doesn't have any paid-in capital, and then no par, which of course, if it doesn't have any par, you have to record it at whatever it sold for, such as on 694, they got $5 a share, and it had no par in one case, and they only got $1 a share in another case, and it had no par. So after each example, you're going to see the stockholders, it's a little bit of a tongue twister, the stockholders equity section of the balance sheet, and it's going to show you how it's presented. And then the stated value is exactly the same as if you issue at a premium. You treat it the same way as if it was par. You have your paid-in capital in excess of stated value rather than par. But it's the same way. You always credit common and preferred shares at their par value, right? Or stated. Always, always, always. The difference between what you got and the par is the additional paid-in capital for either common or preferred. And they give you some great examples here. I'm looking at, where's my premium? Stated value. I'm not seeing my premium. I'm missing it somewhere. Stated value common. Don't know why I'm missing it. Okay. Let's see. 694 I wrote. Okay. Yeah, paid in capital common. At the top of 694. And the bottom of, it's the second half of 693. Notice how they got $5 a share and it was only $1 a share par. So that $4 times the 3,000 shares would be $12,000 of paid-in capital. Okay? That's what I was trying to find and couldn't find it. Okay, so that section ends on all the way down to 695. 696, they do the same thing with preferred stock, and that again, the par here for preferred is $55 a share. Notice how much more of it, oh, I'm sorry, that's wrong, $50 a share, they got 55. So we have our cash at $55 times 1,000 shares that were sold, credit preferred stock at its par value, just like the common. That would be the $50 times 1,000, and then the difference. You can either just subtract the numbers or get the difference per share and multiply it by the number of shares. I learned to do it that way. I think it's easier, but some people just like to subtract the number. They think that's easier. So it doesn't matter, it comes out the same. Okay, and then you can see at the bottom of that page, they show you the preferred and common. Preferred is always listed first also. Preferred stock can be either cumulative or non-cumulative. You might see that terminology. What that means is if it's cumulative, again, it's more expensive, but even if they don't declare a dividend in one quarter or 1 year, they owe it to you. The next time they pay that dividend, they call that dividend in arrears. They have to pay you for the back dividend plus the current dividend before common stock gets 1 dime. Okay? That's cumulative. But if it's non-cumulative, you don't get that back dividend. You only get this current dividend, but still before common. Okay? And there's some examples of that. So, the Treasury stock is the next topic in the next section. That's slides 1326 through 1335. Let me catch up with myself. And that's gives some nice examples of what that what happens with that. And it's a pretty meaty section and pretty easy to follow example-wise. Again, they give some reasons that you might do this. And again, it's listed for us to support the stock price. You don't see these words in this book, but when you sell, the more shares you sell, it dilutes or waters down the price of the stock because there's more shares out there. When you buy them back, we call that anti-dilutive. It's reducing the number of shares outstanding, so it's bringing it back. And that's one reason. Another reason is to give employees bonuses, benefits with the stock options. The biggest reason is you hope you're going to resell it for more. That's the biggest reason. They have it put much nicer. They want to increase net assets by buying low and selling high. But that's what they mean. They want to increase their equity. Always the number one goal of any company is increase the wealth of the shareholder. Always. In this case, many shareholders. So, what I wanted to call your attention to, instead of going over every single example, like every other accounting book I've ever seen in my life, whenever they talk about treasury stock, they show buying the stock at cost. By the way, it's the only type of stock that ignores par value. When you resell it, you use whatever you paid for it. You use the cost method, not par value. It's the only one. It is a contra equity account. It increases on the debit side. It actually reduces equity because it came back to the corporation. It's not out there anymore. But the general pattern, and it's always the same, is they buy back the shares, and then the first time they sell some back to the public, they make money. And they get paid in capital from treasury stock. Just like in this first one, they bought back 1,000 shares and they paid $5. So that's what we're going to base it on. And then they sold it for $5. So it was even break, right? 100 shares. But then the second time they sold it, they got 6. So $1 times 200 shares was paid in capital of $200. So that's what you want. But then they've got 2 more times they sold it. They actually lost money. The first time they sold it, $4.30, 200 shares, and then $4.50. So they lost 70 cents a share the first time and 50 cents a share the second time. So what I wanted to call your attention to was I'm on 699. The paid-in capital from treasury stock would be debited because it's going the opposite way now. It's going down. this account paid in capital cannot be negative. So if you use up all the paid in capital like they do, right, and I think the paid in capital goes down to $60 after the first debit of 140 when they lost 70 cents a share times 200 shares or $140. They had to take that from paid in capital. Notice the balance of $60. I'm on the top of $6.99. Then they sold it again and they lost 50 cents a share, right, times 200 shares, right, $100. They don't have $100 in paid in capital. What do you do when that happens? That's going to happen to you at least once in the homework. You have to go to retained earnings and take it out of there. That's all you can do because paid in capital cannot go below zero. They show you the T accounts, okay, paid in capital. You can take 60 out of there. You got 0 left. The other 40 has to come out of retained earnings. Notice retained earnings went from $35.50 to $33.10 because of that $40 grab. And that was because they sold it twice for less than they paid for it. So it wasn't a good thing for them. So they sold back 700 of the 1,000 shares, so they have 300 left. So the last page of this section, on page 700, it shows you the stockholders equity section of the balance sheet with the preferred and the common, right? And the paid in capital from each one. And then they got the total paid in capital. They add in the retained earnings. Again, they went down by $40. And then the very last thing, at the end, Treasury Stock reduces equity. So at the very last step, you're going to put Treasury Stock at cost. They had they sold 7. They have 300 shares left at $5 a share. So that would be a negative 1,500. And they have a very nice diagram at the bottom showing you, it's a little block diagram, authorized, issued, and then the outstanding shares, right, down to 22,700 because remember they had 23,000, they bought back 1,000 and sold 700. Sold 700 back, so 22.7, and they have 300 left in Treasury Stock. So that's a nice diagram kind of summarizing what happened during the period, their first selling period of their shares. So, we're almost there. My videos 2 and 3 are, the video 2 is about the next section, cash and stock dividends. Fine. So, you can just check out that pages 701, and it should be here somewhere. 701 to 704 for cash dividends for common stock and preferred, and then stock dividends 704 to 707. And I'm not going to spend time going over these examples. You can check them out because I do that in video 2 with the example I do. And it's just like the when you have homework for the lab. Okay, so I go over the small and large stock dividend. In the video, I think we just have I don't think we have a large one. I think we just have a small one. So I'm not going to spend a lot of time on that. What we don't see are the splits. I think you have one homework problem with the splits. The splits are super easy. They don't even need a journal entry. What they're going to do if they split, it's usually a 2-for-1 split. The market price gets cut in half. The par value gets cut in half, but the number of shares outstanding doubles. The example we see here in the stock splits on 708, this is for Greg's Games. They had a 2-for-1 split when they had $1 par, 3,150,000 shares. And when they split, they had a 50-cent par value, but twice as many shares, 6,300,000 shares. So when you have a split, very dilutive. However, the total cash associated with your investment or all of the investments of people, your shareholders out there, doesn't change. Notice the bottom line is still $3,150,000 because par value got cut in half. Also, initially the stock price gets cut in half. But what happens with splits, they create a lot of excitement in the market, and people, because it gets cheap and people jump on it and buy it, and it really pushes the stock price up. So it's good for everybody because there's more shares out there and they stop earning more money right away. Apple just had a split recently, and that's exactly what happened. Okay, so the third video is going to be like the Kevin's Guitars on page 709. We're going to make an income statement for a corporation. And this is going to include income from continuing operations and income from discontinued operations, which means it's a segment or a product line they're no longer doing, and they can segregate it. It's no longer going to be produced or sold, or the location is closing. They're going to give you that information. It's pretty easy to do. We're going to do earnings per share, which is net income minus preferred dividends over the average number of shares outstanding. That's the formula. You don't need to memorize it, though. You see it twice. You'll see it here and you'll see it at the very end. So I'm not going to spend time. You can look over this example for Kevin's Guitars. I'm going to be doing one in the third video, so I explain it step by step. The equity statement of retained earnings, as I mentioned, the same as statement of stockholders equity. Sorry, it's the same thing as the statement of stockholders equity. You can call it the statement of retained earnings. You can see it's done just like we're used to doing it in 101, except instead of the capital account, we call it retained earnings November 1st. Plus net income for the 2 months, it actually is the same as it was in 101, $85.50. But now we're minusing dividends declared. I think the withdrawal account was also $5,000, coincidentally. And the ending retained earnings at the end of December, $35.50. All the numbers are the same, we're just identifying them with different names. Okay. Probably just about the last thing, prior period adjustment on 7/12. Very easy to do. I believe you have one problem to do that has a prior period adjustment. It's a mistake that was made in the prior period that was caught, and you can make a one-line adjustment for it. And you can see, follow this example of the prior period adjustment for Mountain Home at the bottom of page 712. You can see here it's a negative 10,000. I believe it was a problem with their payroll. I think it was payroll expense. Prior year adjustment decreased. The error. Okay, I thought it said. Okay, they're just saying it's a $10,000 error that needs to decrease. So we use a negative for prior period adjustment just on one line. There's no need to go back and change the financial statements from the year before. You can do it this way. It's perfectly okay. And I believe you do have one homework problem like this, which is why I'm highlighting it. An alternative presentation for the statement of stockholders' equity really isn't necessary at this point, but they do tell you International recommends you do for each type of stock the changes, but you don't really have to do it for the United States. I really haven't seen any company do it, except if they're, a global company. There's 3 financial ratios that have to do with stock to close the chapter. One is earnings per share, as I already mentioned. And then there are 2 more. They're very easy. Price earnings ratio and the rate of return, ROE, on stockholders' equity. What percentage are your shareholders returning for every share they buy? So the price earnings is the selling price, like how many times would you earn for every dollar that you buy. So you can read into this. We have the Kohl's example here. We do have a homework problem with the 3 ratios. But again, just follow the formula, very easy to do. So I tried to be as brief as possible. I know there's a lot of meat in this. I think the example videos will help you more, and the things I couldn't really elaborate so much on because we can't do these too long. They take forever to download. But thank you for your attention, and let me know if you have any questions. See you soon.